Hi, good morning, everybody. I think I've been given the go to start. So today's topic is very simple. Usually we run these things every month. It's common questions and uncommon answers, and it's very simple. Uh, Usually this sort of platform is open. You can ask me any question about the markets, about asset allocation, about what you want to do. Don't ask me any stock specific questions that I am not liable to speak about. But this particular platform is open, so you can ask me any question whatsoever. But before that, before I open the floor for Q&A, I have a couple of slides, just as an update of what's been happening and where are we headed in the market and what your expectation should be. So once that's over, I think I can open the floor for Q&A. Right. So this is a favorite chart of mine, which I put in all my webinars, which is just if you look at the outcome, uh, usually investors flow into the market when they're very greedy, when the market starts going up, and it doesn't work out well for them. And what we do at Milestones to Wealth is completely the opposite, right? Only when there's fear, we try to uh, encourage investors to start investing and start saving their money, because at that point of time, valuations are very conducive, and get a chance to book out only when there is high optimism and high greed in the entire market. Right. So the entire market cycle works like this. It doesn't mean that it plays out in a month or a day or a week, but it plays out over long periods of time. So I have a very good chart to show you in terms of how market cycles play out and how different asset classes perform in different years. Right. So moving on. Yeah. So in this month alone, we've had the highest inflow in equity AUM. Right? Not only in equity AUM but also debt AUM. Right. So mutual fund industry is doing extremely well. Right. We are contributing 19,000 odd crores in the entire market just as SIP. Right. So this is you and me investing in the market. This is you and me showing optimism and bullishness in the entire market. Right. And it is reflecting. Right. You're seeing all time high numbers. Right. And that's why you're not seeing a lot of market corrections coming in, and that's why you're seeing all these corrections starting to get bought out because domestic flows have been very strong. Right? So in this cycle, it doesn't matter what FIIs are doing. All that matters is we are continuously contributing. India is extremely strong, and domestic investors are continuously buying into the market, given the fact that we've been supporting them very, very well. Right. So if you see the net inflows into equity, we're reaching all-time highs. Yes, we are having all-time high outflows as well, but inflows have been a lot more than outflows. So your net number again is very high. Right. Now, in terms of where the money is going, this is the uh, this is something that scares me. So if you look at it on a net number basis, this financial year, you had 40,000 crores net going into small caps. Again, you had 20,000 odd crores going into mid cap. Right. And this is why you're seeing a lot of market participants coming in talking about what to do for small caps, what to do for mid caps. And the regulator also has been very active in terms of making sure to curb this sort of optimism. Right. But if you see on the flip, large cap where there is actual earnings growth that is coming into the market, you're seeing net outflows coming. Right. So there's a clear dichotomy, there's a clear gap in terms of where the money is flowing and where the money should be flowing. Right. Second, you see in every cycle risk appetite goes up, and every time risk appetite goes up, you see money going into sectoral thematic funds as well. Right. So if you see net number, it's almost as high as small caps, which is again 24% of the flows that have been coming in. Right. So 38% of the entire flows that have come in have actually gone to small and mid caps, which is again trading at extremely high valuation. Right. So again, I have another chart to show you that yes, this is not a time for you to be doing this. This is a time for you to be rational in terms of where your savings need to go. Right. Now, if you see this, these are just recent news articles. And if you see on one side, you're seeing extreme optimism, stock market has added all-time high, is it expensive? These are all questions that we keep getting from investors itself. What should I do? And that's why we've had this sort of platform for milestones to call common questions, because yes, we do receive a lot of common questions regarding what to do in the market, right? And if you see now, in just in terms of your latest news that has come in, stress test is everything, right? You're getting a lot of tweets, you're getting a lot of articles, you're getting a lot of views on what this entire stress test is all about. Right? This stress test is all about how long is it going to take for a fund to liquidate its portfolio, and a lot of numbers have been coming in. A lot of shocking numbers also have been coming in. Right. So this shows that yes, there is a lot of stress in the entire system, just in terms of small and mid caps alone. But from an earnings potential, India is going extremely strong. India is poised to grow extremely strong. So what do you do in this sort of a market? That's one of the biggest questions that investors need to get answered right now. Now, what is investors? What should you think as an investor? You don't need to think about which sector is going to do well, where is India going. Yes, that data is already there, but what should you do as an investor? You can't think so much of macro, but you need to start thinking micro. Right? What you need to be thinking about is save every month, save regularly. By doing this, you need to go into vehicles that offer you this sort of consistent compounding where you can avoid losses. You can't minimize losses, but yes, here and there, definitely when you have a long term horizon, yes, over a long period of time, you do grow stably. Right? You're compounding regularly. This is where you mix your saving regularly at the same time being rational, being conservative in terms of where you invest, which is helping you to compound regularly. Right? Investing at the right time and investing at the right places, that is something that Milestones2Wealth will take care of. So you don't need to think of that. All you need to take care of is your behavior. That's why Milestones2Wealth was actually created. It's not a recommendation platform. It's not a recommendation sort of a model. It's more from a behavior model where you need to keep doing the right thing from your side and continuously keep saving into the market. Right? These are assets that are going to generate high double-digit returns for you if you keep showing good behavior. Right? FD today is around 8.5%. Your GDP is growing at 7%. Inflation is now coming off, which is a very good sign for companies. So you need to grow beyond that number, right? You need to grow beyond 9%, and then you add that component of inflation. So you need to grow beyond that particular number. And equity instruments are that particular instrument that can offer you this sort of growth. Now, how do you solve this dilemma? This is the most easiest method of how you can make sure that your behavior is right in every market possible. Asset allocation. Now, this is one number. This is all public data. This is nothing that we've had to calculate. These are all mutual fund data. This is all from presentations of mutual funds, mutual fund houses that they publish this data. Right. So if you see what are the determinants of portfolio return variability. This is the question that you ask, right? Why is it that my friend has gotten more than I could in the same period of time? What is it that he's doing different? What is it that I have not done? I should be doing that. I should be doing this. No, that's not the relevant question that you should ask. What you should be seeing is 91% of all uh, variability in terms of returns that you see only has to do with asset allocation. It has nothing to do with timing the market. It has nothing to do with security selection. It has nothing. All it has to do with is asset allocation. So if you see here, asset allocation is the most important decision, right? And this is a landmark study published in 1986, so it's very old, but it's still getting used. It's not that it's irrelevant. It's the most relevant form when it comes to investing. Asset allocation is the most important factor, right? Now, what happens when nothing happens? We see today in a scenario where Nifty is at an all-time high. We are not trading at a deep premium, but to other countries we are trading at a premium. And we've had periods in the past where the starting point has been high for investors, and then nothing happened. So what happens when there is 0% return, right? So from 1997 till 2003, we had 0% return. Again, from 2008 all the way till 2013, we had 0% return. Right. So what do you do in this sort of a market? That's why you should go to other asset classes. Right. In the same period, you see international equities uh, not doing much from 2000 to 2005. Again, gold, which is the best performing asset class in the last 5 years in terms of returns, in terms of compounding. But from 2011 all the way up until 2019, 0% return. Right. So there is a winner and there is a loser in every cycle that comes up. Now, this is the best chart that I can show you in terms of how many winners and how many losers have come up in the last 14 years. So if you see from 2010 all the way up until this was after global financial crisis, you saw gold doing extremely well. But then from 2013 all the way up until 2015, gold did not do extremely well. Right? This is when you are having some sort of negative return. So for anybody investing the market in investing in gold at a high level in 2011 did not see any money being made in a risk-free asset class, right? That does not have much of volatility, right? You see negative returns coming. This changes your whole perception of how you want to invest in this entire market. How do you see savings itself? Your perception gets changed. Likewise, if you see from 2014 all the way up until 2017, you see small and mid caps doing extremely well. Mid caps particularly doing very well. But from 2018 all the way up until 2021, you saw no return being made. Right? You saw anybody whose starting point is uh, uh, at the start of 2018, you will not make any money all the way up until 2021. Your CAGR would be single digit, somewhere around 2 or 3%. Right. So my point is that in every market there is a different winner and there is a different loser. Right. So asset allocation nullifies this and makes you a winner in all markets in all cycles that are there. Right. One thing you should notice is large caps have been consistent in terms of how they've been delivering returns over the past 14 years. Right. Now let's take a temperature check. Where are we in this current market? Right. Like I was talking about how we are trading fair, we are not very expensive. Right, we are not very expensive, but at the same time we are not very cheap. Right. So if you look at the debt side, on the debt side, again there is an opportunity opening up for us, because here you are having debt yields higher than earnings yield, which means there is a gap which you can take advantage of. And this is why in the month I've done on the last 2 months I've done two webinars where we are now starting to talk more about debt and investing in debt instruments, right, where the opportunity is now opening on debt, where investors can comfortably make more than 7.5 7.7% just purely on debt side if something goes haywire on equity. So the opportunity is now opening on that side for us. Right. So this is where asset allocation comes in play for you, where you can take that advantage in terms of investing in other asset classes, be it in debt, be it in equity, or be it global. Right now, there's no opportunity that's coming up on the global side, but debt is definitely opening up that opportunity for you as an investor. Right. So this is the chart that I was talking to you about, how mid and smalls are not uh, in the most attractive, are not the most attractive part of the market. Right. So if you see, they're in the deeper end of the unattractive zone. Right. Back in 2019, 2020 is when they were starting to get a lot more attractive. But right now, given this entire bull market and given what they're earning, just based on that, they're not trading at an attractive valuation. Right. So as a smart investor, you need to make a call as to where your money should be being parked right now in terms of equity. Then you have that opportunity in terms of debt, and you have that opportunity in terms of growth. So asset allocation makes you a winner in all markets. So what should you as an investor expect in this market? Right. So if you look at the first 3 years of your investment, your journey is going to be extremely volatile. So you look at the number of reds that are there here. Right. The number of reds are extremely high. So your first 3 years naturally are going to be extremely volatile. You need to have a 7 year to 10 year sort of horizon when you're looking to invest in this market. Right. 3 years plus, that is 6 years in, you see the number of reds starting to go off and the number of greens starting to come in. So a lot more stability is coming in after the fifth year of your investments. And after that, further on, you see a lot of greens and you see 9 to 12% coming in for you. And that's what your expectation should be as a rational investor who is looking to invest in India. Not only in terms of one asset class, who is looking to invest in India. So your expectation should always be benchmarked to that number. So if you're doing more than 12, then definitely you're doing a good job. If you're doing less than 9, then you're not doing a good job. Right. So that's then again it comes on your goals. So if you have a particular goal in which debt allocation needs to be more, so you need to be hovering around somewhere around 7.5 to 8% given the current market context. So that's not bad for you as a debt investor, right? But as an equity investor, definitely you need to take that call, right, over a long period of time. Right? So now I'll open the floor for Q&A. So you can type in your question in the chat box, and I'll do my best to try and address it very, very openly. So there is a question on whether this is the right time to increase your investments in consumption and energy sector. So definitely right now, consumption sector is now opening up to become an opportunity. So last 5 years, I've not seen any return. Last peak was in 2018, right? And from there on, you're seeing high inflation starting to affect these consumption-oriented companies, right? And now you're getting that opportunity because inflation is coming off. So it would take a quarter, 2 quarter or so for that to reflect in the bottom line. But definitely, there is an opportunity that's opening up. So if you would like to know what we are doing on Milestones 2Wealth or on the consumption side, just send us a hi on that. I've put the number. You can email us, but just send us a hi, and somebody from our team will get in touch with you and guide you in your in investing in consumption as a sector. So we are doing it in Milestones 2Wealth. But what would suit you, we would have to see only based on your risk profile and your appetite, and only then take that particular call. So if you want to invest a lump sum, see, this is a very good question because at this given point, there is lump sum coming up only in certain parts of the market. So there are only two sectors that are giving you that sort of lump sum opportunity, and large caps as an entire basket is giving you that lump sum. So we are able to take that sort of exposure on Milestones 2Wealth. And the journey for Milestones 2Wealth has been of handholding investors when it comes to investing money, and making sure that first they are at the right place, and then starting to take sectoral calls, and then starting to take other asset allocation, other assets call, right? But now we are having a we are having a good split between large cap, between sectors. At the same time, we are now starting to add more on debt. So right now, lump sum opportunity is majorly on just two sectors and large caps. So how much return can you expect on debt? So right now you can expect somewhere around 7.5 to 7.7% on the longer term side. Shorter term gave you an opportunity sometime last year at the same rate, and now long term also is starting to open up in that particular option. So right now there's no call of a rate cut, but it would be favorable for uh, debt market if there is a rate cut. Second, we have gotten included in two global indices, which is again very favorable. You will see a lot more flows coming into debt market. You will see a lot more of debt market deepening and broadening, which means that it will become a lot more liquid. Today, the only part of debt market that is liquid is more on the government side, right, and more on commercial paper side, right. So you will see debt market sort of developing. Debt market in India is still very nascent. Even globally, it's still not as developed as equity, but you will see a lot more coming in on the debt side. So there is a question on, has the ITO team done any interpretation of the stress test? Yes, we have. In fact, in the team, we have analyzed every small cap fund to see, uh, who's having more allocation towards high free float companies and low free float companies, and the results have been staggering. But from the number that has been given by SEBI alone, uh, if it's taking a fund 22 days to liquidate 50% of the portfolio, 27 days, then it's a cause for concern. It's a big concern actually, right? Because as the sooner you're able to liquidate when a bear market comes, or when volumes go off, or when there's a big sell off, the better. But as it takes you longer and longer, when you're having more illiquid stocks coming into the market, you stand to lose a lot more at every fall, right? Because you're not able to sort of liquidate. And that's the only worry. And that's a very big worry when it comes to investing in small caps. And you have to applaud SEBI that yes, this test has been done. They've been very proactive. They've been very proactive when it comes to, you know, uh, taking a call for retail investors. You saw that there's 40,000 odd crores that have gone into small. There's 20,000 odd gone into small. So it's not a small sum. So naturally, this was bound to happen as to the regulator stepping in and making sure that things go right. Okay, so there is a question on for the past 2 years. I've been doing an SIP with M2W. So thank you for your support. Your money is going into more thematic, sectoral, tech driven, and that out of all large cap is doing comparatively lower. Yes. So this is the so let it go on. What you need to do right now is start looking to step up your SIP as and when you get bonuses, as and when you start getting something extra. Because right now you can start topping up small lump sum investments in those funds alone. So you can get in touch with your point of contact. And yes, we are sending regular messages from the central number as to we just sent one 2 days back in terms of giving a call on lump sum investments. So use such opportunities because we will be very proactive when it comes to giving out this particular information. So what you can do right now, right? When valuations become favorable in small caps, that is a call for that time. There's no commitment as of now of things have just started, right? Things have just started in terms uh, of how they are going to unfold. So there's no need or there's no pressure to sort of commit to small and mid caps right now. Right? But overall, you would see this sort of a structure in terms of having a core portfolio that is then topped up with certain themes, with certain sectors on which we can go overweight on. Right? So this is how we are building portfolios based on your risk profile and based on your objectives that are there. Okay, so there is a comment saying, as of now, I'm being recommended for one small cap fund which is having longer liquidity days. I will check on my POC if there's something to be done for that. See, the whole point of the stress test is to just see how long it will take. If like when you want to liquidate or a fund manager gets redemption pressures, he will be forced to go out and liquidate everything. Right? And there's stress test is only to see how large this problem is, how large can it become. Is it something that needs to be addressed right now? Right. But the stress test does give out a lot of. It is something that we should be taking seriously by saying that yes, they have been able to generate a lot of returns because they've been there is a bull market here on the shorter tail of which are a lot more illiquid. Right? Companies that are a lot more illiquid. So there is a comment saying I'm also in M2 but not getting any lump sum investment alert. So why don't you just send us a hi and the team will just check if you're on that list or not. But definitely we are giving out lump sum calls. Uh, Both your point of contact and the central number is sending out messages both in terms of webinar invites, in the conferences that we are having, webinar recaps, as well as lump sum plus SIP calls. Thank you for your support. I'm always asking for feedback as to topics that you want me to cover. I think in one of the last webinars, there was a good suggestion on uh, when we should rebalance our asset when should we rebalance our asset allocation. So I've taken up that feedback, and we are going to do something at the end of the month. So you will get some invites. It will come out on social media. It will come out via the central number. At the same time, next month also we are doing something regarding asset allocation. So you will again get invites from us. It will come out on all our social media handles, and looking forward to having your participation there as well. So if you do have any topic that you want me to take up as well, please do put it in the comment box. I'm very happy to take it back to the team to see if we can do something about it, uh, and hopefully take it forward. I think there are no further questions, but if you do have any question, just send us a hi, just send us a question, and somebody from the team will get in touch with you. But looking forward to have you all on the M2W program. Our objective is to only improve our behavior in terms of saving and investing in the market, and become better investors going forward. So that's all I have to say, and thank you all for joining in. I think there is somebody has raised the hand. So go ahead. You can ask me any question if you would like. Okay, so I don't see any further questions. But thank you all for joining in on a Saturday afternoon. Have a great weekend, and I'll see you again for the next webinar. Thank you.